Hi, investors. This is take number 5. We're trying to do this so that these videos are moving quickly for you and you're not seeing us faff around looking for stuff on screens and what have you. So, the idea behind the plan with this video is just to talk about the market conditions as we see them, what's viable, what's not, what we predict. And with that in mind, I'm going to do a bit of share screen with you, and we're going to just quickly look at the interest rates that are being offered at the moment with Octopus Finance. Now, as of this video, as far as I know, Hampshire Trust Bank are not in the market yet, and Gatehouse is not in the market. But as an indication, if you were to say that they were going to enter the market soon, and they will do, I expect, then we know that uh, prior to the mortgage shakeup, these people were about 1%, their interest rates were 1% higher than the competitors. So let's say that for various reasons, the market settles down. And these reasons are due to the cost of money with interbank lending and so on. Plus, we've had the Bank of England interest rate rise. So my guess is interest rates will be somewhere around the 7% mark. And based on a whole bunch of calculations, which I'm not going to bore you with, but the net result is that if you were borrowing, say, if you're buying a £200,000 property, then if you're paying 7%, then you'd have to go in at around 65% loan to value in order for that to break even, which then means you are tying up quite a lot of money in a single property. It would be better to have a higher loan to value, but considering certain circumstances, etc., it's difficult. So it's break even. If you assume 7% interest rates, it's break even around 65% loan to value, assuming the property yields are around 6%, which isn't great. And then you have this other issue about what the market's going to do. And I'm going to share screen again. And broadly, the way markets tend to work, certainly this is the cycle since 2003. And in the last crash, we had a cataclysmic financial event and market dropped 15%. Now, this time around, it's less of a cataclysmic event and more of a slowdown. And let's say a catastrophic slowdown, which is just likely to drag the market down. Now, whenever you consider property prices, there are two variables. One is the actual house price inflation and consumer price inflation. Rent is tied in with consumer price inflation because rent generally goes up with the cost of living. And property prices are kind of tied into affordability, really. So, in other words, as you have inflation over time, properties tend to spring back to an affordability ratio, and then they tend to normalize. So what happens every 18 years or so is you have periods where property gets more expensive relative to income, and then it comes back down again. And so what I expect to have happen here, as we saw in the 1940s, was that due to inflation, prolonged inflation, property prices get relatively more affordable. And so the likely outcome in this cycle is that property prices are possibly going to decline by 5% or something like that. They'll readjust. But because we have such chronic long-term inflation mixed in with relatively low interest rates, I would say the likely outcome is similar to the 1940s, where we're in the middle of a period of conflict, i.e., Ukraine, a whole bunch of things going on, and there are bouts of inflation, but interest rates didn't rise that much, and this is due to government debt. So there's a whole thesis which I could get into in detail, but the point is that the likely outcome is that we're going to see house prices go sideways for a while, and then gradually, as inflation keeps rolling along, wages increase and therefore affordability improves on house prices. therefore house prices go up. I hope that all makes sense. So the ultimate everything is affordability ratios. And so therefore the best strategy, as far as I can see at the moment, is to buy properties that produce good cash flow and hold their value, or are likely to hold their value with the market, and are likely to grow in value when the market comes back. So what does that mean in practice? Well, it's going to be properties somewhere around the 130,000 mark, 130, 150,000 pound mark, which are good quality, i.e. their build quality is good, and and where we've got motivated sellers who are willing to sell a bit cheaper. So if you're buying with cash when mortgages are difficult to get, then this is good. And so that's generally what I'm seeing. And so the idea is that you enjoy the cash flow from them. Then you when interest rates decline again, which I expect they will, then you refinance. So you could finance short term and just buy more properties but not get any cash out of them. Or you could get the cash out of them and use that money for whatever you want to use it for, and then just wait. And then when property prices, when interest rates drop to a sustainable level, then refinance. And then once you refinance, you can then start to buy more properties with your money before house prices start to creep up again too much. And the reason you can do this is because there's generally a window of opportunity where the public think that the world is about to end and they're not buying, but you're looking at it objectively and you're going, okay, it's time to go. Now, your other choice is you just sit with your cash and do nothing. And that can kind of work, because if you only want to spend your money on houses, then assume that house prices will go sideways for a while, or you'll be able to grab opportunities to buy property cheaper because of motivated sellers. Then yeah, that can work too. It just depends on how you want to play things. But ultimately, if you sit on cash, your cash will devalue. So it's just what do you want to do? Um, my general feeling about all of this is that we're now starting to see people really in trouble. So I saw a survey recently where something like 30% of the population, let me get it because it's quite an interesting one, and it highlights a very important point. So I saw it on BBC today, and it was about savings. Uh, and it was so it's basically search savings survey. Yeah, this is the one. So see some of our Asian friends, and a quarter of people not even having £100 set aside to cover cost of living increases. So what does that mean in effect? Well, a quarter of those people, there are going to be a lot of people who live in property and they're getting absolutely screwed by mortgages. They're running out of cash and they're sitting on a lot of equity. And if they're in survival mode, they will sell the property. The only thing we're seeing is quite a strong demand still. So there's a lot of cash around, and there are still people around with money that are buying properties up. It's just getting much easier to buy property, that's all. And so it's all shifted really to, if you got money, you can buy property easily. But now what we're transitioning into, I would suggest over the next couple of months, is if you've got cash, you can buy reduced properties very easily. And and the trick is to find good quality properties which are reduced. The issue is all about finding the right property which doesn't have condition or location issues. So with that in mind, Martin, can you show us some properties of interest just to give everyone an example of what we think would
Yeah.
work?
So, for example, right now on the market, usually the property what will works is less than 150, I will say, because usually those properties have higher yield. So for example, this is example of one property in Liverpool, 116, 3-bedroom terrace house. Demographics are okay, and the crime is low in this area where is the property. So yeah, it's not the best, but it's a good deal. So as you can see, the condition wise is also okay. It's renovated. So
And
it's like
here's a good example, just to say, to renovate a property like that, we know because we're doing a lot of renovations these days, would be about £30,000,
pounds. Yeah,
and they're asking 116,000 for it.
yeah.
So,
And it's
so
a large. It should be like a large property.
hmm.
Also, there is one author property. This is show here.
But the trick with all of this
So
is to get good demographics. So whilst it's a nice property and so on, if it's in a bad area and the market lifts, then will the property lift with it? And fortunately, we have loads of capital growth data, so it's quite easy for us to see how a given area has behaved over time. And from that, we can then work out whether it's a good bet for future growth once the market comes back.
it's good just because you see you have plenty of new builds. Usually, new builds is always a positive thing. You can see it's some part here, but also you can see a lot of new builds coming here near the river. So that's
Have
always
you
positive.
have you got any properties that you shared on the groups, for example, just to
Yeah,
show?
yeah. I will show. So this can one be in Stoke-on-Trent. Like Stoke-on-Trent is not maybe. Um, oh, here it is. Oh, wait. Maybe it's old. Big. No, here it is. For example, 2-bedroom terrace house. The rent should be around 625 to 705 yield, which is maybe not the best, but still good. The condition wise is good. So, and the location is okay as well. Basically, it's central Stoke-on-Trent. So I think this property works as well because demographically is okay. They don't have really a good garden, but it's okay, still okay. It will rent, so and it will give a good yield. Basically, it's, I don't know, maybe 10 years ago renovated. So yeah,
Yeah, so
this
this is typical of what we're after. These are properties which are
yeah, and
fundamentally
also
sound. Hmm? Go on.
yeah, and also I shared this one, but this one needs a lot of renovation. And yeah, as you can see, in 2007 it was sold for 75k, and now they're asking again 75k. So, but the condition is really poor, like you can see. It's, but for this price of property, like you will need a new kitchen, and it have some damp issue. But this property will give you like depends how much money you spend for renovating, but it will give you 8+ yield. So and depends. It's not the best, like, but still okay. Still okay
Okay. So
location.
so
It's near
let's.
Wigan.
Hmm.
It's still part of Greater Manchester. So yeah, and also it's close to the train. So everything should work with this property as well. So basically, what I'm sharing, all the deals, what I'm sharing are most of them are like cheaper with a yield more than 7. So because even for this property, if you don't buy it in cash, and if they go with a 7 in 7% of interest rates, then you will have a chance to buy it down with 75%, not to value 70%. So these deals will work out with the mortgage purchase.
Yeah. So one of the only issues with these lower priced houses is mortgage financing, and Gatehouse were they were offering minimum mortgage £75,000. Then they got flooded with applications. Then they stopped. And we don't know whether they're going to continue offering £75,000 mortgages or not. We will see. Hampshire Trust Bank continue to say that £100,000 is their minimum mortgage size. But what you can do is you can get portfolio lending with them. So, in other words, you might buy a couple of these properties, let them sit, get the cash flow out of them, and then refinance once things have settled down, i.e., refinance a couple of properties, and then you could buy more property with your refinanced cash, which banks like you to do. So, so that's broadly it. That seems to be the viable game plan. Um, yeah, there it is. So hopefully that's helpful. And anything final from you, Martin?
If you need help to find a good deal, we can discuss. Try to find your best deal to invest.
Yeah.
Bye.
And I suppose my one thing I would say final is that we are specifically searching for properties that have come back to the market and properties where we know there are motivated sellers, because that's where the value is really. So all the same criteria as before, just people who are motivated to sell. That's what we're after. All right, then. Thank you very much.
Thank you.